Yeah, it seems crazy, but I'll tell you, when we first did our Tesla projections, when we first did our Bitcoin projections, these are early signs that we're onto something here.
Before we move forward, I'd just like to remind you that we're giving away $100 to a random subscriber at the end of this month. To take part in it, all you have to do is subscribe to our channel, like this video, and leave a comment in the comments section below. Good luck. Now coming back to her interview, Cathie Wood talked about her own holdings and how inflation and other factors have affected her portfolio. She talked about Tesla, why she believes in Elon Musk, and why she chose to invest in Coinbase. She also talked about stocks and where she thinks the entire financial sector is heading from here. She then moved on to the latest moves by institutional investors and explained how the retail investors took advantage of the former's ignorance. If you want to hear Cathie's comments on the crypto market, watch this video till the end and don't forget to press the like button. Now, let's look at his interview.
Well, it's interesting. This all started with Tesla, too, and Bitcoin.
Wow, we got to Tesla pretty quick. Great.
Yes, it does. No, but Bitcoin in 2015, Tesla 2014-15, and we had what seemed like a crazy estimate out there. But it was all modeled, very data-driven. And I think what the market's missing is they are not focusing on something called Wright's Law. Wright's Law is a relative of Moore's Law. Moore's Law is a function of time. Wright's Law is a function of units, and it says for every cumulative doubling in the number of units produced, costs decline at a consistent rate. Theodore Wright was a civil aeronautics engineer, and he observed during the early days of airplane manufacturing this law. And so if you and back then I think the cost, Sam, correct me if I'm wrong, is 10% roughly for every cumulative doubling in the number of airplanes manufactured. You fast forward to today, and in robotics, industrial robotics, that number is 50%. If you look at battery technology, that number is 28%. DNA sequencing, which is, I know, not in this room, but 40%, 28% for short read. So these are massive deflationary trends evolving all at the same time. So we're going to see S-curves feeding S-curves, and I think we'll see it in space especially. The capital will be there once, and I'm saying both in the public and private market. I think in the private market what we're seeing, and this is a throwback to that 2018 conference, which was, we remember one VC venture capital leader after another getting up on stage and saying, oh, we would never invest in this. This is too high fixed cost. This is too long term. Or there were many excuses. And so it's been very interesting. There is a lot of capital moving into the asset-light part of the business, and still maybe an aversion to the more hardware-centric. But we do think that will change over time. So if you look at our performance, our flagship's performance, from the low in COVID to the peak in February of 21, that was 360% increase. Innovation solves problems. We had a lot of problems through the coronavirus. Innovation solves problems. We were rewarded accordingly. Since then, peak to trough, when we hit our trough, thank goodness we're past it, down 75%. Why? Inflation and interest rates. So there is this, and it's really interesting to be here, Walmart territory, because I think we're learning a lot from the retailers now.
And we're talking about what we learned about inventories.
Inventories,
right.
Yes. The fear of rising interest rates and inflation out of control has gripped the market. And of course, and that's the equity market. If you look at the fixed income market, it does not agree with this.
Yeah.
The 10-year Treasury bond yield is 3%. That instrument should be one of the most responsive to inflation fears, right? So 3%, which suggests GDP growth 3 to 4% during the next 10 years. So it's not being corroborated by the fixed income markets. And I don't think that we are in a period where we can't extricate ourselves from this. In fact, the inventory stories are a very good example of why inflation has become a problem. You know, the scrambling to bring more and more inventory to satisfy demand, stay-at-home demand, went into overdrive, and I believe the narrative in the last year, inflation, gave purchasing managers this idea that, okay, what's the worst that could happen if I build inventories? The worst that could happen is that I'm able to deliver inventory profits, sell at a higher price. Well, that's not going to happen. That's not going to happen. When we see, I've never seen inventory surges like this in my career, and I've been around for a long time. So 33% at Walmart, 42% at Target, 74% at, 50% at Kohl's. So very broad-based. And so I think we're going to see a lot of discounting. And what's beginning to happen now, just at the margin, and we're seeing it because our strategy is now starting to outperform the rest of the market. I've never been in a market where the market has gone to new highs and we are hitting lows. I've never been in a market. So there's been, and it hasn't been supported by the fixed income market. So we'll see what happens. I think it is seeping into the investor's mind is, wait a minute, are we right on this inflation call? They felt so right because supply chain issues extended for such a long time. Then Russia invades Ukraine. Of course, monetary and fiscal policy had been so stimulative. But as I've said many times, we think the greater risk, by far, is deflation. Deflation cyclically.
But you're talking over a longer time horizon.
I'm talking about now, too, because I think this inventory issue highlights the cyclical reason we've been saying we think inflation will unravel. The secular deflation story is very powerful. And as EVs and autonomous mobility of all stripes starts becoming a bigger base in the economy, that deflationary pull is going to be aggregated because, again, these are convergences between and among different technologies that are all on their own deflationary cost curves. Yes, and I'm not saying investors should put 100% of their equity exposure into ARK. Now, is my own personal portfolio like that? Yes, but I wouldn't suggest it for most because this is a truly volatile strategy. So we have a study up on our site which says if you allocate 5 to 10% of your equity allocation to this kind of strategy, innovation, solely innovation, you will increase your returns per unit of risk over a 5-year period. And very important is 5-year period. We are the closest you'll find to a venture capital fund in the public equity markets. And of course, we're acting like it. In fact, we led this VC down round. The VC down rounds that we're seeing now were led by the public markets. Now, I don't think the public markets have this right at all. I think that we are in bargain basement territory in terms, if you give us a 5-year investment time horizon, we are a deep value portfolio. I think the private markets are closer to right, but there was a wall of money pushing in and there was some bad behavior, so we are in a reset here. I don't think we'll go down to public market valuations. I think that we'll see kind of an adjustment both ways. We pay attention to a site called Metaculus, which basically anyone can put their forecasts in there, but they are basically graded over time. And if you look at since OpenAI released DALL-E 2, foundation model in AI, and I think Google's version, Alphabet's version is Flamingo, that service has gone from flat. When do you think artificial general intelligence will occur? It's been flat for the last 2 years, but since those two models have come out, the time that these forecasters expect to see artificial general intelligence has shrunk from 30 to 50 years to 6 to 12 years. So now, it sounds impossible to think that GDP growth, sort of that 3% real terms and so forth, is going to accelerate to 30%. But if you look at the history over thousands of years, you will see that at one point in time, GDP in the economy. Now this is thousands, maybe hundreds of
I
thousands.
wasn't around then, so yeah.
0.003%, then for another 1,000 years, 0.003, then 0.03, then 3%. Who's to say we aren't close? I just mentioned these S-curves feeding one another. Yeah, it seems crazy, but I'll tell you, when we first did our Tesla projections, when we first did our Bitcoin projections, these are early signs that we're onto something here, right? And I would look at those forecasts, and Sam and Tasha were responsible, and I was saying, wow, this is a tall order. And what did we see? It's playing out so much closer to what we were expecting than to what IHS, which is the auto forecaster out there, was expecting. Just to give you an idea here. In 2014-15, when we were starting our intensive Tesla work, IHS was predicting for 2022 that the number of electric vehicles sold globally in 2022 would be 250,000. Okay. Last year, it was 4.8 million. This year, it'll be
okay, what did they get wrong that you got right on that?
They're probably listening to the traditional auto manufacturers too much.
Okay.
That they were listening to the forecasters within those organizations. When we're moving away from the internal combustion engine, that was the wrong place to look.
Okay.
And towards battery technology, and they weren't paying attention to the advances in battery technology, thanks to Elon and others, as well as the cost declines in batteries. They also weren't paying attention to how quickly China would move.